My name is Brian Johnson, a former institutional investment manager, and am now a full-time proprietary trader. The purpose of this video is to demonstrate the first of several spreadsheet tools that accompanies my new book, titled Exploiting Earnings Volatility, which introduces a new analytical approach to evaluating, optimizing, and trading option strategies to profit from earnings announcements. Before we get to the spreadsheet, we'll need to review a few concepts that will help you understand what the spreadsheets are attempting to calculate. First of all, every option price is a function of its implied or expected level of volatility. As the expected level of volatility increases, the option price increases as well. As the expected or implied level of volatility decreases, the option price will also decrease. Now, it's especially interesting to look at options that expire after an earnings announcement. The implied volatility of options that expire after an earnings announcement is actually a combination, or in fact a weighted average of, two different components of volatility. The first component is the implied earnings volatility, which is the expected level of volatility associated with the earnings event itself. And the second component is normal implied volatility, or essentially the level of volatility associated with a normal or non-earnings day. Now, when earnings announcements are made, they represent new information related to the price of that stock, related to earnings, revenues, and other information that helps investors determine what the value of that security should be. Since it's all released at a single point in time, it represents a discrete change in the price of the stock, which can represent a significant level of volatility associated with the release of that new information. So the aggregate implied volatility formula that's introduced in the book allows us to quantify and separate the two components of volatility, implied earnings volatility and the normal level of implied volatility. When we look at the level of implied volatility as we approach earnings, the weighted average of those two components changes because the weights change. In other words, as we move closer and closer to the earnings date, the relative importance of implied earnings volatility increases. As we pass the earnings date, obviously we return to the normal level of implied volatility. We eliminate the earnings or the source of volatility associated with the earnings event, and we're left with normal implied volatility. So by being able to quantify those two terms, we can model implied volatility as we approach earnings and as we pass the earnings events, which allows us or provides the information necessary to exploit earnings opportunities. Now let's take a look at the spreadsheet itself. The spreadsheet has several different functions. The ones we're going to talk about today is estimating the implied earnings volatility that was embedded in the market price of options for a specific security, Under Armour, which was also featured in the book, on a past earnings date. So to do that, we're going to need to input several pieces of information, all with blue backgrounds and white text. So the first thing that we need to input is the analysis date, which is the closing date immediately prior to the earnings event itself. In this case, for Under Armour, we would input the date of 4/23/2014 in cell C2. Now in the cell immediately below that, you see the value of 105%. 105% represents just the starting point or an estimate or a guesstimate that we're going to start with the estimate for the market level of implied earnings volatility on that date. Now we're going to use the spreadsheet itself to calculate the actual value, but we're going to do that a little bit later after I explain the rest of the fields. So once we input the analysis date and the market level of implied volatility, we need to enter information for the UA options at the money UA options immediately prior to the release of earnings on 4/23/2014. So the first piece of information that we need to input is a series of expiration dates for the at-the-money options themselves. Those values are entered into cells B5 through B15. For each one of those options, we then enter the implied level of volatility on the closing date immediately prior to the earnings event itself. So for the first option, we enter 105%, which was the implied level of volatility for the first option in the option chain, first at-the-money option in the option chain that had an expiration date in this case of 4/26/2014. We do the same thing for each of the other options, each of the other at-the-money options, entering respectively the implied volatility for each one of the at-the-money options on those dates. Once we've done that, we then go over and enter the implied volatility for each one of the same options on the first close immediately after the release of earnings. So going back to the first option again with an expiration date of 4/26/2014, initially had an at-the-money implied volatility of 105%. After earnings were released, that implied volatility dropped all the way to 39.8%. So we enter that same value, the implied volatility immediately after the earnings event, for each one of the at-the-money options. So what that does, that now allows us to calculate the actual change in implied volatility from immediately before to immediately after the earnings event. As you can see, the first option in the option chain started at 105%, immediately after earnings dropped to 39.8%, representing a 65.2% decrease in implied volatility. So why did the implied volatility drop so dramatically? Immediately before earnings, it was expecting a significant level of or price change associated with the earnings event itself, but once we passed earnings, it reverts to a normal level of volatility, which explains the volatility crush or the large decrease in the level of implied volatility. Now conversely, if we look at the last option in the option chain, or the long-term options, you can see that they did not drop that dramatically at all. In this case, only dropped by 1%, and the last two options even increased by slightly, 0.4% and 0.9% respectively. So you can see that the changes in the implied volatility is actually a function of the time remaining until expiration, and that relationship is actually captured by the aggregate implied volatility formula. So if we look at the estimated changes due to the aggregate implied volatility formula associated with the 105% expected level of earnings volatility, we see that those estimated changes are listed in this column. We know the actual changes are listed in column L, and if we subtract the two, we find a series of errors. In other words, we can estimate a series of changes, we can look at the actual changes, and that gives us another set of error terms, one for each option, and the average of those errors is 20.7%. So we can see that the 105% expected level of earnings volatility does not accurately explain the change in implied volatility that we experienced across each one of the options in the option chain. The 20.7% average error is obviously significant. But again, keep in mind the 105% that we started with was just a guesstimate. We're actually going to use the spreadsheet solver function to solve for the market implied earnings volatility immediately prior to earnings itself. So to do that, we need to go to Data and Solver. And Solver will use the objective function in this case. It's going to minimize the value in cell M3, which is currently 20.7%, by changing cell C3 which was the original 105% term that we talked about. So it's going to try different values in cell C3, 105%, to come up with the level of market implied volatility anticipated or embedded in the option prices themselves immediately before the Under Armour earnings event itself. So to come up with that, all we have to do, the solver function is already set up. We click on Solve. We click on OK. And solver has actually gone in and estimated or solved for the implied earnings volatility, which is now 143%, that best explains or minimizes the error between the expected level of expected change in implied volatility and the actual change in implied volatility and the series of error terms between those two. So in doing so, it found that the market implied volatility immediately prior to the 4/23/2014 earnings event was 143% on an annualized basis or 9% on a daily basis. That level of implied earnings volatility corresponds to an average error of 1.73%, meaning for the first security, the option that expired on 4/26/2014, the implied volatility immediately prior to the earnings event was 105%. The implied volatility immediately after the earnings event was 39.8%. The aggregate implied volatility model came up with an expected level of, or expected change in implied volatility of 64.9%. The actual change was 65.2%, meaning the error term was very, very small, 0.3%. All of these values, the expected change, the minus 64.9%, were based on solver's new value or solver's optimal value of 143% for the implied level of earnings volatility on 4/23/2014. So that explains how we can use solver and the aggregate implied volatility formula in the spreadsheet to automatically solve for the market's level of implied earnings volatility on a past earnings event. Again, this value was 143% on 4/23/2014. So how could we use that value in practice? To use it in practice, what we would really need to know is, in addition to that fact, is what is the current level of implied earnings volatility in the marketplace today or prior to the next earnings event for Under Armour. Let's say, for example, that the market's level of implied earnings volatility on today's date was only 100%, but in the past it was 143%. What that means is that the value is actually much lower today, which means the value of options would be much lower today, and it would also mean the implied level of earnings volatility is low. So we could construct a strategy to exploit that difference, meaning that we're going to buy volatility or buy earnings volatility because it's cheap. The spreadsheet will also help you design strategies to accomplish that. If the current level of implied earnings volatility was, let's say, 200% instead of 143, then the expected level of implied earnings volatility would be too high, and we would actually want to sell implied earnings volatility and construct a strategy to exploit that difference. So the next presentation or the next video that will be presented in this series will do just that. It will show us how to calculate the current level of implied earnings volatility, which one we can then compare to the past level of implied earnings volatility and make a strategic decision to design an optimal strategy to exploit those differences. If you would like to learn more about some of my research, you can visit www.traderedge.net, where you'll find a series of blog posts. You'll also find links to the books that I've written, specifically the most recent book, Exploiting Earnings Volatility, and also my first book, Option Strategy Risk-Return Ratios, which introduces a new approach to optimizing, adjusting, and trading any option income strategy. In addition to the book links, which you'll find in the right sidebar of the Trader Edge site, you'll also find the link to a strategy that's offered as well. And finally, you'll find links to 15% discount offers from Trader Edge affiliates. I hope you enjoyed the presentation, and please tune in to the next presentation for additional information on how to use the spreadsheets associated or included with the Exploiting Earnings Volatility book. Thank you.